Saving for retirement can feel daunting. The same goes for managing your money once you've stopped working. That's why we've created an 8-week newsletter series breaking down what you need to consider, both pre and post-retirement, into bite-sized chunks. If you sign up to our free retirement newsletters, for 8 weeks we'll send you an email full of expert guidance to help you take control of your retirement planning and give you the confidence to make smart decisions. We'll help you get to grips with your pension, teach you how to boost your income, and explain more about care options. It doesn't matter when you sign up either. Your 8 weeks of advice will start whenever you sign up. So what are you waiting for? Head to which.co.uk/retirement newsletters, all one word, to get up to speed on everything you need to know for retirement.
Hello, it's producer James here. I'm sitting in for Lucia this week, and we're talking all things property and mortgages on the podcast today. Now, we recorded this episode on Tuesday, just a day before the ONS released its latest inflation figures. So if you're wondering why we don't touch on that, that is why. There's still plenty of great advice coming your way though. So let's get on with the podcast. Welcome to the Which Money Podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm James Rowe in for Lucia Ariano, and here's what's coming up this week.
Let's be honest, mortgage rates aren't going to go back down to 1.5-2% anytime soon. The landscape isn't massively probably going to improve for first-time buyers anytime soon. So it may be that it's the time to take the plunge.
It's still a challenge for first-time buyers getting a deposit together, but we're still seeing really strong appetite from first-time buyers because, of course, they're also being hit by high rents.
Following the Bank of England base rate dropping to 4.5% earlier this month, and with an impending stamp duty change, we're at a key point in time for anyone buying, selling or remortgaging a property. Plus, with house prices rising by around 3% last year, 2025 could be an interesting year for the housing market as a whole. And joining us to explain all, we have Which mortgage expert Stephen Maunder. Stephen, hello.
Hi, James.
Good to have you back, Stephen. And we've also got David Hollingworth, Associate Director of L&C Mortgages. David, welcome back.
Hi, James. Good to be here. Thanks.
Great to have you back again. David, I'm going to come to you in a second, but Stephen, I'm going to kick off with you. I mentioned the base rate dropping to 4.5%. Were we expecting that change?
Yeah, I think we were. Yeah, I think it would have been more surprising if it didn't drop. We saw a couple of reductions in the second half of last year. The market's kind of priced in 2 or 3 reductions this year. I think a lot of experts are expecting it to maybe end 2025 at around 4%. So although the progress in lowering the base rate and mortgage rates last year was slower than expected, this means that this year's got off to the start that we thought would happen.
And what happens with this is usually the case is that we're anticipating a decision, a change, or whether they keep it the same. And then attentions always change, don't they, to what it actually means for us. So what does that new drop mean for buyers and people who are looking to remortgage pretty soon? Well,
I don't want to put any dampener on it too early on by saying that because we expected this to happen, obviously the markets had already priced this in. So we probably won't see any massive change in the short term, but David will be able to explain more on that shortly. But it ultimately means that we haven't started the year with a dent in confidence for buyers and people remortgaging, which may have been the case if the base rate didn't go down. What it does mean is that the journey of travel appears to be on the right direction for where we're expecting it to be, and there's room for some confidence if you are looking to buy, sell, remortgage this year. Although, as we found late last year, there are lots of factors that impact the cost of mortgages, and a base rate cut of 0.25 percentage points in this instance does not necessarily mean that mortgage rates will drop by the same amount.
And David, this is the third time the base rate has dropped by 0.25 percentage points since summer last year. It was at a high of 5.25%, wasn't it, in summer 2024. What does this signal, if anything, for the property market as a whole?
Yeah, so I think For consumers, really, it just confirms that we are on that downward trajectory for interest rates. I think we've had a lot of talk about rates will come down, and then it's been a case of, well, when will they come down? And now we can see some clear momentum building with that. And I think that will just act, the biggest impact will be it'll act as a boost to confidence. So as Steen says, I think people will start looking ahead through this year. And if they were thinking about moving, they'll feel a little bit more confident the rates aren't going to just suddenly shoot up, because in the last few years, we've had some bouts of extreme volatility in the mortgage market, which pushed mortgage rates really high at some junctures. Now we've started to see those easing back. Now we've got the potential for that to continue as base rate starts to fall. And as Stephen says, fixed rates will be pricing that in already, but we should, if base rate does keep dropping, we should start to see some easing back in mortgage rates over time as well. So it's a rather better place than it has been in recent years, and actually one that will hopefully help people make big decisions like moving house.
And that is the key question, isn't it? When we see a drop in the base rate, we always then look to see whether those mortgage rates are going to drop as well. But with us saying that we were kind of expecting a drop, have mortgage providers almost, priced that in, and we won't necessarily see much from a consumer perspective?
So lenders are pricing so as sharply as they possibly can. And so that kind of rate war is bubbling along all the time. But at the back end of last year into the beginning of this year, again, we saw cost of funds for lenders pushed up. So actually fixed rates started to edge higher, even though we were anticipating this base rate cut. Actually, inflation figures were better than expected. We've now had a base rate cut. Fixed rates are slightly reversing those increases. So they're not huge drops, but there's a lot of lenders just looking to tweak their rates and bring them back down. So it is a lot of bobbling up and down with fixed rates, but it's still a rather better place than it has been in recent years. And borrowers are therefore looking at locking in fixed rates. Fixed rates are taking the large proportion of business. People are still favouring that security, and the rates are a bit lower. But I think it'd be interesting as base rate does continue to come down. Will we see a few more considering the merits of a tracker rate, for example, and whether that might give them some flexibility and the potential to drop further.
And for people who are on tracker mortgages, who aren't locked into a fixed rate, what kind of benefits are they looking at the moment? Who's best to answer this one? Can you sort of put this base rate drop into sort of real terms for people who are on a tracker rate?
Yeah, so they're the ones who will get the immediate benefit from a base rate cut. So they'll be delighted to see there's a little bit more momentum building. You know that your rate will come down if it's directly pegged to base rate. If you're on around £200,000 mortgage, it's probably just shy of about £30 a month, something of that order. So every time we get those rate cuts feeding through, it's good news for variable rate borrowers. But of course, all the while, they have been paying rates which are higher than the fixed rates that are currently on the market.
So not an insignificant reduction, it's safe to say. £30 a month, it certainly does add up, doesn't it? But on top of the base rate change, there's also a rush to beat a stamp duty change, isn't there, on the 1st of April. David, can you remind us what's actually happening and what current homeowners and prospective homeowners need to be aware of with this?
Yeah, so this is effectively, we'll see the reversal of the relief that was given on stamp duty bandings. So the zero banding was pushed up to 250k for all borrowers. And then first-time buyers also saw an enhancement to the relief that was already in place. So that's all going to be reversed. So it will ultimately mean that you're going to have a higher stamp duty bill. It will mean that the nil rate band is up to 125k, and then 2% between 125k and 250, so home buyers. So £2,500 increase there. First-time buyers already had relief, and that had been enhanced, so nothing all the way up to 425k property purchase price. That will now revert back to the original 0 to 300k, and then 5% to 500k, whereas previously the very highest limit was £625,000 property. So if you look at the absolute extreme for a first-time buyer, that could be over £11,000 difference, although that is at the very highest end of the purchase price. Most of them probably won't feel that kind of pain, and it will be much more limited. But nonetheless, worth having if you're already in flight and you can get your purchase over the line before the end of March. There's going to clearly be a rush to do so.
I'm pleased you mentioned that, because that's something I want to try and clarify with you, David. If you're the best one, or Stephen, feel free to jump in. Because when do you actually pay the stamp duty? If somebody's listening right now and they are going through the home buying process, is it really beneficial for them to try and get this purchase over the line before the 1st of April? Otherwise, if they still haven't completed by the 1st of April, is that when they fall into this new bracket and we'll have to pay a bigger fee?
Yeah, it's that much of a cliff edge deadline, really. So if they don't meet that deadline and complete the following day, then it will be the higher rates that will apply. It has a direct impact on how much that stamp duty bill is going to be.
This could be a big financial hit for a lot of people, couldn't it, Stephen? You know, they're trying to get the house purchase over the line. I've been through this myself quite recently, and I know you can just get stuck waiting, can't you, for other people? If you're ready to go and somebody else isn't, you could be pushed over the line into this new bracket.
Yeah, absolutely. I think there's only so many things you can control when you're buying a house, especially if you're in a chain. And, you know, you can obviously have a great conveyancer, you can get everything done from your side as quickly as possible, but ultimately you're kind of at the mercy of so many other moving parts and factors. And as David says, in some areas this will have a significant impact. I think outside of London, we looked at Oxford and Cambridge when we did a bit of an analysis on it, and we found that someone buying their first home at the average first-time buyer price using land registry data pay around 5,000 or 6,000 more in tax from 1st of April. And I think the data from Hamptons shows that at the moment 8% of first-time buyers pay stamp duty. It's going to go up to 24%. Gosh. So as David says, for some people it might be a few £100s here and there, but for other people it'll be many thousands.
After the break, we've got plenty more discussion to come, including house price predictions for 2025 and advice for anyone buying or selling this year. Hi there, James Rowe here, presenter of the Which Cars podcast. Join me and the Which Cars team as we cover the biggest motoring stories, including our exclusive research into car reliability.
When 5 to 9-year-old cars break down, they spend on average 4 days off the road. New to 4-year-old cars spend 4.8 days off the road. Now that might not seem like much in the general scheme of things, but that's a 20% difference. And that could be the difference, for example, if you break down on a Monday afternoon, between getting your car back for the weekend or having to wait into the next week to having it repaired.
Should you buy a used car rather than a new one?
Unless you're desperate to get a car in exactly the colour or specification you want, there are plenty of low mileage used cars on the market with significant discounts on their new price. And if they're from a brand, say like Toyota or MG, which offer long warranties, then it can actually be quite a good option buying used, because you'll still have that manufacturer cover behind you.
And why are car headlights so bright nowadays?
Car manufacturers want to make life easier for the driver, so they add these LED or laser headlights that illuminate the road ahead like never before, which is great if you're driving a car. Not so great if you're on the receiving end coming the other way.
To listen to the full podcast, head to which.co.uk/cars podcast. You have to be a Which member to listen, but you can get a membership for 50% off the usual price. All the details are on that page, which.co.uk/cars podcast. Welcome back to the show. Now, David, for anyone looking to buy a property in 2025, do you have any house price predictions for the rest of the year? What do you think can happen?
Well, I'm not going to claim to be a housing economist. That's the first caveat right now. But I think when you look at some of the big house price indices, they're kind of telling very similar sort of stories. Nationwide's latest was talking about annual growth just over 4%. Halifax was stating 3%. So these are kind of low single-digit growth annually. With base rate coming down, I think that you will expect to see that there'll be more activity in the market. So where house prices have been more muted is just because simply there aren't enough transactions going on, both from people sitting on their hands and not putting property on the market, but also those looking to make the decision to move. I think now that interest rates are on the way down, that has been a key factor in that, and particularly with the impact on mortgage rates. So as we see an improving position there, in what is a very competitive market, lenders have really got significant appetite for mortgage lending. So I think we will see improvements, and I think that will help to bolster confidence, because that's what's been holding the housing market back. Now, I don't think that necessarily means that we're going to see house prices rocketing, but I think you will continue to see them in positive territory.
So when we put all these things together, everything we've discussed so far, so the base rate cut, the rise in stamp duty and house price changes, are we going to see a slowing of the housing market, or do you reckon these factors could lead to a bit of a boost in home buying? Stephen, do you want to go first?
I don't think we'll see a slowing housing market. I think, as David said, there's a certain amount of pent-up demand out there, and I think that people who have maybe been putting the blocks on the idea of potential moves, I think may, at this point, as this year progresses, decide that, let's be honest, mortgage rates aren't going to go back down to 1.5%-2% anytime soon. The landscape isn't massively probably going to improve for first-time buyers anytime soon. So it may be that it's the time to take the plunge. And I think last year, towards the end of the year, we saw a rise in transactions year on year. I think in the next few months we'll see that again, but it will be artificially increased by the stamp duty holiday. Stamp duty holiday ending, rather. So we could see that rush kind of go in February, March, and then a bit of a lull afterwards while things kind of flatten out and we wait and see what happens next.
David, what do you think?
I agree with all of that. So I think it'd be interesting to see what happens in April, May, whether we get a little bit of a vacuum created by people bringing purchases forward to try and meet the stamp duty deadline. But I do overall think that we're going to see a boost to the market as rates come down. And when I say boost, that's perhaps, over-egging it a little bit, but I think people will start to think again about whether now's the right time. They'll just feel more confident about the direction of travel for interest rates, and I think that will bring them back to market. And going back to the house price forecasting, we've got to remember that regionally, house price just varies so dramatically. So it's still a challenge for first-time buyers getting a deposit together, but we're still seeing really strong appetite from first-time buyers, because of course they're also being hit by high rents. So the desire to buy remains. It's a case of how affordable is it, and can they find the right property?
And for first-time buyers, we see that average age of buying a first property is creeping up and up. I think I read the other day it's about 33 or 34 years of age to buy a first property. But there is clearly appetite, isn't there, for people to get on the housing ladder. Is there anything more that the government can do or needs to be doing to try and support first-time buyers get on the property ladder?
So I think that the big push from the government is all around increasing supply of property, which will definitely, in the longer run, help the market. So there's much of the big house price rises that we've seen has come down to ultimately demand outstripping supply. So the government is really focused in on that house building target. And I know a lot of people will say, well, they're never going to achieve 1.5 million, but at least they've got the ambition to try. So in the longer run, that will help the market as a whole. That will help improve the supply of affordable homes, we hope. And therefore, there's good news down the line. But of course, it's about how quickly that can feed through. And in the meantime, first-time buyers are still struggling with those twin challenges of building a big enough deposit. So using things like the lifetime ISA can help there. But secondly, just with affordability and meeting mortgage affordability. So lenders are looking to increase the supply of products where they can, and be more flexible in what they can lend to first-time buyers in order to try and head that challenge off wherever they possibly can.
And that 1.5 million number you mentioned is the target for this government for homes to be built over this Parliament. Stephen, it is an ambitious target, isn't it? I think we've discussed this before on the podcast. Is there going to be some difficulties with achieving this target because of local communities or disputes with the home builders themselves? Is there going to be a bit of a coming together, do you think?
I think it's going to be a huge challenge, but I don't think there's necessarily a problem with setting lofty goals and lofty targets, but I think the reality of a sort of world where 5 or 6 kind of scale home builders are essentially building 80% plus of what we would consider to be the kind of properties first-time buyers purchase will create an issue for the government. And I don't think it's as simple as people are blocking developments or house builders are land banking necessarily. I think there's a lot more nuance in it, and what the previous government very much went with the big kind of huge policy announcements. First homes obviously came after Help to Buy. We had starter homes where nothing got built, quite famously. But what they were trying to do with those policies was essentially finding a way of incentivising industry to build more. So, for example, with Help to Buy, as we saw over its lifetime, property prices on Help to Buy homes rose hugely, and it was the developers who were making quite a large profit on that ultimately. But for many first-time buyers, it was the difference between being able to buy or not. So it had a lot of positives too. Whereas I think that is the challenge the government will face is, it's all very well saying like get Britain building, but how do they actually do that? And just to pick up on one of David's points around affordability, I said this a few months ago when we last did this podcast, but I think it's really sort of disappointing that we haven't seen anything yet from the government around affordability of buying a home. So essentially we've had the mortgage guarantee scheme, which encouraged lenders to offer more 95% mortgages. They're offering lots of 95% mortgages, lots of 90% mortgages, but they're still tipping over 5% on rates. And this is ultimately way too expensive for a lot of first-time buyers. And as I said before Christmas, what I would like to see is I'd like to see, rather than kind of huge proclamations of like major housing targets, I'd like to see a more kind of granular look from the government of how can we encourage lenders or incentivise lenders to bring those rates down? Can we take some of the risk on? Because 5% really is a kind of punitive amount. So I know it's not historically, but in a world where first-time buyers are buying homes at £300,000, £400,000 plus, it's a hell of a lot of interest to pay.
Well, shall we get to advice for people buying a house in the short term and then people buying a house in sort of the longer term? Stephen, for you, should we do short term, i.e. before this stamp duty change? Is the advice just to try and do everything you can do to try and get it across the line? Is that the short term advice?
Yes. If you're already in the process of buying, you've got a decent chance of getting it over the line. I think if it looks like you might not get it over the line for reasons beyond your control, you may, if you're someone who's going to face a bill of £4,000, £5,000, £6,000 more in tax, you may wish to revisit that with the person selling the home, because it could be seen as a justifiable reason to renegotiate what you're offering for it, which could then obviously slow down the process even further. But obviously the additional cost after April will be pushed onto the buyer. But and David might be about to say this, but ultimately it's already a price-sensitive market, and people facing higher costs will look to shave off those costs elsewhere, i.e. in what they pay up front for the home.
David, what do you think? Firstly, on Stephen's point there, but then also for people looking to buy a house in the longer term.
Yeah, so we've been advising people to think about that potentially higher stamp duty bill for quite some time now. So trying to manage expectation, it does take a long time to get a purchase over the line, and particularly the longer the chain is, the more difficult that can be. So as Dean said earlier, control the controllables at risk of sound like a football pundit, but you can only look after the stuff that you can control. So try and be really prompt with all the stuff that you've got to get back. Any requests that you get, be prompt, be quick. And that will help you then when you're trying to put the pressure on to get the thing over the line before the stamp duty deadline. In the longer term, I think, the rules really are always the same. Get a good idea of what the local market's doing. It will really help you understand what's moving quickly and what's not. That will in turn give you a very good idea of what prices the market should be at. So if the more properties you see, the better the idea you will get of whether someone's pricing too high or not. Understanding your own budget is critical because it's not just stamp duty, of course. You've got legal fees, you've got survey fees, you're going to have costs coming with the mortgage. So understanding where you can go to and what kind of mortgage borrowing you can get and how much that's going to cost you. If you've got that all in hand in good time, that's going to put you in a better position for when property does come up that you want to get moving on and actually make a serious offer.
Plenty to think about there then, but shall we wrap up with some more general advice? Stephen, do you want to go first? What's on your mind that we haven't covered yet?
Sure, I think if you're a first-time buyer, I've written here, which sounds quite bleak, but I've written don't wait for things to get better, which sounds quite bleak, but it shouldn't be, because I think what I'm trying to say by that is while affordability is still challenging, things are improving. If you buy a home now, there's a good chance in a couple of years the mortgage rates when you come to remortgage, if you take a 2-year fix, will be a bit lower again. So if you are able to buy now, then it's not necessarily a bad time to do so. Just take your time, take advice, and best of luck with it.
And David, what else have you got for us?
Yeah, look, I think that's correct. And we are starting to just see an uptick in first-time buyer and home mover activity. Slight, but already starting to see that improving. We talk a lot about mortgage rates and for obvious reasons, but actually it's perhaps worth highlighting that lenders are trying to maneuver their criteria as well, particularly around affordability for first-time buyers. So a lot of them are very focused on helping more first-time buyers get onto the ladder. So it may be worth revisiting how much you can borrow. In some cases, lenders can offer enhanced affordability. Now, there will be eligibility around that, but if you haven't looked at the kind of amounts you may be able to borrow for a while, there may be some new alternatives that are on offer. So lenders looking to offer maybe 5.5 or even up to 6 times income now, in the right circumstances, of course. This isn't just a one-size-fits-all approach, but it's worth getting advice and just seeing whether you can stretch to that limit that you need to get to in order to take the first step on the ladder.
Some solid advice there and plenty to think about. I think it's a great place to end as well. David, thank you so much for joining us.
Thank you.
And Stephen, thanks very much.
Thank you, James.
Well, a huge thanks again to Stephen and David for coming on the show today, and to you for listening to this week's episode of the Which Money podcast. If you enjoyed today's show, then please do hit subscribe to make sure you catch our new episodes as soon as they drop. For daily money news and advice, you can find us on social media at Which Money and online at which.co.uk/money. We also have a free money newsletter, which is delivered to your inbox every Monday. To sign up, visit which.co.uk/money newsletter. This episode of the Which Money podcast was presented and produced by me, James Rowe, recorded by Rob Lilly-Jones, and produced and edited by John Weeks.
Next time you need to get work done on your home, or your car, or your garden, make sure you choose a trader you can trust. And don't just choose any trader, choose a Which trusted trader. Our trading standards professionals only endorse traders who've passed our rigorous assessment that includes credit reports, customer satisfaction surveys, reference checks, and interviews. When we say a trader's good enough to display our Which trusted trader logo, you can trust us. But don't take our word for it. Search Which Trusted Traders online to see our directory of around 4,000 traders. Every customer review you read there is verified genuine by our moderators, so you can choose with confidence. To find a local trader you can trust, search Which Trusted Traders or go to which.co.uk/traders. That's which.co.uk/traders. Everybody needs a trader they can trust.